In Q4, let's bring in Michael Kantrowitz, Chief Investment Strategist with Cornerstone Macro. Michael, welcome. It is great to have you with us today. When you say tighten your risk exposure, what does that mean? What is that code for?
Well, we're at the part of the market cycle right now, putting today aside, where high risk doesn't equal high reward. We're moving along to as earnings begin to stagnate, as the macro data is really kind of at peak levels. And so this is not the time to really go for a reflation trade, a swing for the fences. It's really low risk, high reward, or we're certainly moving that direction.
You say de-junk your portfolio. You've got a list of about 40 different stocks that you say investors should avoid, which I guess means if you got them, get rid of them. If you don't got them, don't buy them. This is kind of a sell list. Tell me how these stocks, and then maybe Kelly can follow up with some specific names. Tell me how these stocks ended up on your naughty list.
Sure. Yeah. You'll see some stocks like Disney, Chevron. A good company can sometimes be a bad stock, and a bad company can sometimes be a good stock. And that's all dependent on the market cycle and the macro environment. And so a lot of these names are flagged as they're a little more volatile. The fundamentals they're more expensive than their peers. And there's some accounting that, for example, accrual accounting that investors usually look for as flags as we look into earnings quality, which will really be paramount as we go into 2022.
And there are some names here, Michael, that include Boeing. You mentioned Chevron, Disney, Wynn Resorts, both Norwegian and Royal Caribbean are on here, Caesars. In Las Vegas Sands, all the way down to Enphase, an energy play there as well. Phillips 66 also on the list, and General Electric. So are you pretty agnostic in terms of, stuff that pops up on the screen, or do you try to go through and say, okay, well, actually some of these names we think are pretty good opportunities?
This sell list is really just a cautionary red flag list. It has attributes that investors really start to navigate away from as the cycle matures. And as we go into 2022, we're expecting a synchronized global slowdown. We're already beginning to see earnings stagnate. As Michael Santoli just said, many stocks have gone sideways here. And so it's really become a stock picker's market, and earnings revisions, those that are having positive fundamental momentum, are seeing outperformance. And so that's what we'd stick with.